Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly commodities update with our friend Marin Katusa. So welcome back to the show, Marin.
My pleasure.
You guys have been on fire lately with some of the picks that you shared with us, some of the stuff you share for free on your website and in your newsletter. So we're going to get into all that today. You guys have given us some great questions in the comments from last month's episode, as well as in our group. So a lot of people want to know about the swap lines, what's going on with the banks and who's funding who with all the geopolitical tensions and the US dollar becoming a weapon, as well as the gold to silver ratio and some of these other ratios like the Dow gold ratio or the GDX to gold ratio. So we're going to get into a lot of those things today. But anything as just a brief overview of what's happened in the commodity space the last month, Marin?
Look, gold's been on fire. It's flirting with that, it's attempting to flirt with the 1800 level. And I got to say, it's doing incredibly well. It's consolidating very well above 1700. That was always my risk, was let's see how it goes. But we're seeing a lot of political risks globally, not just in the US, what's going on, even though that kind of takes most of our feed from our social media and news outlets. But gold's reacting really well here. The question is does it break or does it pull back? I don't know. I'm not a guru on where the price is going to go, but the equities have just exploded. And I'm seeing so much product come out that is really down the food chain. Bankers are busy again. So it's a cautious time right now.
I think the liquidity that's just been flooded into the markets, it's so clear when you look at a chart. You know, the SBX looks similar to the GDX gold miners, and it's just everything had that huge sell-off, and now it's popped back up, and some of the gold stocks have just been really outperforming. But yeah, I just want to touch on that before we get into it. Had a conversation the other day with someone, and what you said to me in the pre-interview was, when you're reading some of these newsletters that are out there, or you see these TV shows, sometimes it's the worst projects, and it's similar to the crypto space where the bad projects will pay the most money to get in front of an audience, particularly retail audience. So just got to be aware of all those things, don't you?
Oh, so, there's a simple filter. Why would you ever follow anyone that doesn't have skin in the game and doesn't tell you what price they're buying the stock, right? And if a newsletter writer is being paid to promote this stock, his best interest isn't for you, the subscriber. It's for the company that he's getting paid by. So be super careful. And why would you ever follow anyone who can't buy something? So if it's a wrong pick, it's just like, oh, well, another pick for them. Follow someone who's putting a lot of dough into these companies and at the same price as you, at the same price as the management. Because like you said, the kick-ass management team, they don't pay for that crap. So stick to the best.
Yeah, and I think our audience know that I've got a lot of skin in the game in the crypto world, and Marin's got a lot of skin in the game in the metals world. So let's dive into the swap line. So something you've been talking about a lot is the idea that these companies, they need money from somewhere. And again, let's give people a real world example. I strike gold somewhere in Australia. There's not a lot of VC funding that's out there, or people that are necessarily hungry to fund it. Or even if we do, we've got to go to a bank, and you're the US bank. So you create a sort of swap line with me to get a lot of US dollars flowing into my country. What's been happening in that space? Is that becoming like a real strength play that they're leveraging that now, or is it something that's sort of eased back a bit?
Look, India on the front page just recently talked about, the swap envy. Like, they don't got a swap line, right? So they want a swap line. Turkey's been talking about how they want a swap line. Well, if you're going to get a swap line, it comes down to accepting the terms and conditions of the U.S. Fed, the government, right? So this is, nobody in the political world has been talking about this yet because of everything going on in the U.S., but it will. But I can't tell you how much negative feedback I've gotten from this, and you have to ask yourself why. And I'm going to share something that's in my website. I don't know if you've watched the interview with an incredible, intelligent guy named Tom Kaplan. Now, people may not know that name, but he's one of the most successful resource investors ever. Like, the guy is true. And he's not a geologist. He's not a mining engineer. He's probably the world's best political risk assessment guy. He was an advisor. His thesis was on the Saudi attack on Kuwait, and he built strong relationships there. He reached out to me. I met him before, maybe about 5-6 years ago, but we had no relationship. And here's probably the guy who's been to more countries than me. So he's been to like 130 countries. I've been to 116. We talked about that in the interview. And the US government reached out to him because he was pretty much the largest investor in resources from Africa all the way out to, I think it was Kazakhstan. Anyways, in all these countries, he was the largest mineral holder. And the video on the swap line that I did, the war on gold, was sent to him from a large fund manager. And the fund manager said, "Is this guy full of shit?" ? And Tom said, "Well, I'll watch it." And Tom talks about this openly. And here's probably the best risk guy in the world for resources. And responded, he said, "No, he's totally on par here." Now, so who's doing the pushback? Let's talk about that. So you look at so many of the resources. Obviously, the management teams of these negative swap lines are not liking me. Okay, that makes total sense. And I knew that going in. A lot of the royalty companies are really pissed off at me. And these are guys that are, friends or positive social acquaintances. They didn't like it because it's bringing a lot of questions to them about the risks that nobody is talking about. And fundamentally, Alex, let's just bring it down to a street level that a grade 5 can think about. Would you give the same discount something in Central Africa as you would in Nevada or, just by where Fosterville is in Australia? No. But that's what the industry is doing. These analysts put these 5% NPV using 1550 gold US, and whether you're in, Kurdistan or the DRC or Nevada or Quebec, they're doing these models as peer comps. Well, after you go and travel to all these countries, you get a quick realization that, and I'm not taking those political risks, and I'll put my portfolio up against anyone in the industry. You don't need to take those crazy risks to make big returns. And that's why I'm getting a lot of pushback, because it's pissing off a lot of people who are in that sector. And the only time you get pissed off is maybe if someone's right about it, right?
I've also been hearing, I've listened to a few interviews in the commodity space, and there's been a little bit more of an appetite. So we've seen some mergers and acquisitions, and there are a few probably resource funds that are now competing even to sort of fund some projects. So is that definitely more a sort of local thing if you're in those jurisdictions like the US or Australia where there is a bit more money?
You nailed it on the head. The big one that has really happened was SSR merged with Alacer. SSR was kind of a North American. They were the old silver standard.
Yeah.
And the Alacer was pretty much solely in Turkey. And what do you think is happening there? Well, what nobody's talking about in the market is it's actually the Alacer management are taking over the combined entity, but it's a merger of equals at market. So they did all the right things for the market to like. Now, the way I understand it, I don't want no lawyers coming after me. The way I understood it, my interpretation, I may be wrong, this is my interpretation, is the management of SSR are moving on. They're retiring, so they get their golden packages. They win. The management team of Alacer, who are, Ed Downing, how I know, who's the chairman, smart, successful, savvy, has de-risked his portfolio, and that management team are taking over the entity. That's worked for him and their investors. What about the SSR investors? They're getting, now this was a merger of 2.4 billion equal, like they're like 4.5, 5 billion market cap now. And I'm looking at this going, those guys just got diluted with Turkey risk. Where something like Equinox has a better resource portfolio is trading half the price. And they're in all 100, they're producing assets, and they're going to be a 1 million ounce producer within 2 years. And you have Ross beating these guys. Why the hell would I take that risk when I can go in 100% positive swap line producing assets and not deal with Turkey?
So we often joke that sentiment drives all markets, whether you're a technical analyst or this sounds like it's a case of something that's been in the news cycle, and it would have been through the mining news and sites, and that's what just builds awareness, and that's where they can sort of build a price premium where on paper, as you say, there might be other companies with the same resources but in better positions. Yeah, okay. Interesting. That is good to know. We'll continue to talk about that because I think the US dollar, well, let's dive into US dollar strength. Have you had any other changes in thoughts about Brent Johnson's US dollar milkshake theory? Because the US dollar has been, I guess, weakening in general the past few weeks. Yeah.
I admire Brent's ability to engage with the trolls online. He's a good guy, okay? And everyone's basing these things in little quick snapshots. And so much, it's called financial heroin, has been pumped into this market that the hopium is out there. And of course, things are going to be alleviated, but we haven't even started the insolvency phase. And I've been talking about this in my newsletter going, okay, this injection is going to come up. Obviously, the US dollar is going to pull back. But ask yourself, like if you're traveling, China is talking about the issues with the US dollar denominated debt. You got India asking for swap lines. Like this hasn't even really started. From what Brent's concept is, he's playing this longer game. For example, I'm in Canada. Canada just got downgraded to AA plus from AAA. So for a country like a G7 country like Canada to be downgraded makes total sense, though. Look at the economy. So what's happening in the stock market and the US dollar versus what's happening in the real market, it's never been as fragmented. Like the stock market used to be a good a tell on how the economy is doing and going to do. That's been totally like that's not kosher anymore. So we're in this real risky market with all this stimulus coming in and financial heroin and all the, I call them, like I wrote this article about Robinhood and all like the sport traders. That's a huge business that has been closed because the sports are down, and they're doing the Robinhood day trading, buying stuff, following gurus with cigarettes in their mouth and that are entertaining. It's gone cowboy style. And there's this, the last time I saw this was during the tech boom, when guys like Druckenmiller and Warren Buffett and true super successful over 30, 40, 50 years are being made fun of by the media because of these fly-by-night guys. And I'm sitting here going, hold on a second. When Druckenmiller or these super, like a Buffett, all these truly brilliant, and they've survived all these markets, are saying, hey, this doesn't make sense. Maybe it doesn't make sense. So I push that concept on. What Brent's talking about is he's dealing with the daily, the US dollar is at $1.36 Canadian. Oh, it was $1.43 during the crisis. His theory doesn't make sense anymore. Or a Peter Schiff will come out when I moderated them too. He's like, oh, the theory's bullshit because it doesn't fit his narrative. No, Brent's thesis is actually really smart, but he's playing a multi-year story.
Yeah. And
so many people want gratification today. Well, then they probably shouldn't be in the market to begin with, number one. Number two, my money's in Brent's fund, not someone like Peter Schiff's fund. And I've got access to pretty much anybody in the sector or in the business. And trust me, I'm probably the cheapest person you've ever met. And I don't put my money in without some serious due diligence. So my money's on Brent on that one.
Yeah, okay. I think one of the best examples of that long game is what's happened to gold and silver. So when I first went down the rabbit hole 10 years ago, and then you endure this bear market, and you think, what is the market sort of seeing that I'm not? There's all this money printing and debt, negative rates, and then it takes the sentiment and the market to pick up on that narrative that's probably been clear the whole time that government's going to have to print money and this, that, and the other, and now the market's picked up at it, and gold's the all-time highs again. But it was kind of there all along. But you've got to play the long game.
Yeah.
Okay, so let's dive into some of those other ratios. One that I've been looking at is the M2 money supply. That's been hugely inflated, trillions of dollars in the last few weeks. The ratio of that,
but the velocity. But hold on a second, Alex. The velocity of the M2 is at the lowest point in the last decade. And that's what people have to understand is the velocity. So right now, all this money came in. Yes, I concur. But the velocity of how it moves, and that's where we're seeing the true fragment. Now, I'm not trying to be a geek and show my old calculus days, but velocity is being so not spoken about in the market. And think of velocity of is the dollar just going here and staying here, or is it working its way through the system? And it's not. It's at its lowest velocity. That's bad. That means that interest rates are going to stay lower for longer. That's bad for the economy. And I talked about this stuff a year ago with the FTDs and quantum economics, where we're at with the financially transmitted diseases. But do you know what the best yield in the big markets in the U.S. You talk about the different sectors. Do you know what the number one year-to-date gain has been?
In what, bonds or corporate bonds or?
Sectors across the board, like whether it's gold's number two, it's at 19% year to date.
Have financials had the biggest bounce or?
No, 30-year treasuries.
Okay, yeah.
So think about that. Like, oh, wait a second. So if Brent was so wrong, and these, like, the irony is I'm a bigger financier than all these like gold guru guys bashing Brent. Okay, number one. Number two, you got to be a pragmatic and look at the situation and going, okay, and so many of these guys are talking, the same bullshit for the last 20 years. The US dollar is seriously, you have to focus on this. And I'm not saying in the next 3 months it's going to go from here to there. It's actually irrelevant when you're playing this long game with the gold. And more importantly, be careful where we are. Like gold going to 1800 actually scares me for many fronts. It is going to attract this retail crowd and a lot of new money coming in. And I hope they don't get sucked in. If we get anything today from this conversation for your crowd is be careful of going down the food chain, because what happens in every bull market is people get sucked into going really down. Basically the shitty stuff gets marketed really well, and don't get stuck on the bottom of the food chain. Stick with guys like you were saying for 10 years or 20 years that have been around. They've gone through, they've got their scars. They know what they're doing. Not the fly-by-nighters that are paying huge fees to these bankers to promote this stuff and get money. That's what my biggest worry is at $1,800 gold. And with more passive money being managed now than ever before, what happened in the last cycle, a lot of these big fund managers would invest in this early stage to put 25% of the portfolio in exploration. That ain't happening. The index funds are not going to be doing that. Like if you look at even the GDXJ, it doesn't invest in juniors. You got to have, I think, I'm not 100% sure, but it's about $250 million. And you got to meet all these different metrics. That's not a junior anymore. So much of the sector won't be viable for the passive funds, and that's where the biggest allocation is. So the rest of the people looking at it, be very careful, because when you're buying something, you got to look at the catalysts, what's going to happen, what are the costs of what the management say they're going to do, what does it actually cost, and then if they get there, then what? Like, who's going to buy the stock to go up higher? Because don't forget about, dilution, because these guys don't produce any cash flow. So how are they going to get their increase the value of their company as they need more money to explore and advance these assets? So your value, like about 10 years ago, I came up with gold per share value. Just simply look at, with simple math, you can look at it and go, is this company diluting my interest per gold, or is it increasing it? And 9 out of 10 management teams are diluting their shareholders. So be careful about those things.
And I completely agree. That was the velocity was the next point I had, because that is something we've covered a lot as well. Let's dive into what you said now, because it's a similar thing in the crypto space where people hear about Bitcoin and then they might look at the others, and instead of just going, yes, this is a space that's fast growing and I'm early and I'm going to do well, and if I invest for 5 to 10 years, they go down the food chain. They try and pick the coin that's going to go up 100 or 1,000x, where we've seen it in Robinhood. The stats of the people that own the double and triple leveraged ETFs has just grown 20-fold, but the people that just come in and buy GDX or GDXJ, it's insignificant. So people go for those huge gains and they end up worse off. Yeah. Okay, so next thing I was going to get to is those ratios. Even though you said the velocity of money is low, the M2 is sitting there in the reserves and it's possibly going to move in future. So people complain that the indexes are overvalued, but there's a lot of money out there. But then we look at the gold to Dow ratio, and that's at all-time lows, or commodities to stocks ratios. And then within that, you can look at the gold miners versus gold ratios, or even the silver to gold ratio. So you go down this food chain of things that are at these like all-time low record ratios. And does that tell you that, look, nothing's guaranteed, and history, it's not going to repeat perfectly, but this tells us that with all this money, once it starts moving, the rotation, the sectors that aren't overvalued like everything else, it just looks like it's perfectly set up for money to rotate.
So the problem with the indexes is the weighting of how the indexes work. So you got to be very mathematically attuned to the misdirection, right? So that's one aspect, and that's a whole issue in itself. But I agree with you. Like if you look at where the streamers are expensive, and the royalty companies, and people get mad at me when I say this and they hate me for it, but when something's trading at 3.5 times NAV, that's not cheap. Like that's not Warren Buffett value investing stuff. But what it is a lot of passive money is coming in and going, hey, it meets our criteria. We need this much exposure to gold. And they don't get into that. A lot of these royalty companies are getting almost half or 2/3 of their cash flow, or their free cash flow, from these negative swap lineations. And as gold goes higher and higher, and they need these US dollar because of the insolvency. Remember, we've just hit the part in the US where they're 12-year highs on bankruptcies. Well, that's going to be a pattern across the board. You look at what's gone on with the velocity of capital in India, for example. They're the largest manufacturers in the diamond industry. Well, that sector's just gone evaporated. Think about the bankruptcies there within thousands of manufacturers. That's just one little subsector of a massive economy. This insolvency and bankruptcies is going to it's just starting, where what's going to happen to that point, and then from there, software is eating the world. I don't care what you're looking at, but you look at your phone or any of these things, we're in a deflationary environment, and you look at these high paying jobs, specifically in these gold mines across the world, and they're going to be so coveted, and not just those jobs, but you're going to see the nations need that product, whether it's going to be putting royalties on these royalty companies before, because people are shocked that they've used these tax treaties to bypass paying taxes in the local country and not even paying taxes in their own country. There's a lot of questions there. But what happens if they just say, no, we're changing the treaty? Like there's going to be a lot of tears in this $18, $19, $2,000 gold, because the number one important quote was when Barrick was in a battle with a nation in Africa, and he said, well, I understand that you have to respond to your shareholders, but I have 8 million shareholders in my nation that I have to respond to, meaning the citizens of the country. And I can assure you that no politician is going to side with a foreign company when they're locals and their businesses, because what do you do with the people when the insolvency starts on these corporations, right? That's the real big black swan event that I think is going to hit hard, not just in the US, but that's why they're stimulating to hell and buying these corporate bonds. They're scared. Like, think about in Q1, we were at January was 3.5% unemployment in the US.
Yeah.
Near all-time lows, maybe all-time low, whatever, pretty damn low. And then last month was 13 and change.
With the official metrics.
Huge move, right? And think about all the stimulus that came in, and it's still not enough. Now we're starting to see the bankruptcies just explode. Now the bankruptcies aren't these, the companies like Amazon and all these big companies, the Nifty 50 and all those things. But we're talking about the companies that actually employ the majority of, and as you have deflationary pressures and software pressures and, the retail world, the restaurant world, all these impacts because of the coronavirus, and will there be a second wave? And then put that globally. What about Brazil's insolvency issues? What about Mexico? What about, then you start getting into China? What about their black market, or they call their alternate funding regions? And you look at what's going on, and then the 2020 election. I just hope that where I'm positioning my subscribers and myself and saying to everyone is, make sure you know what you're invested in and what its true value, not that's market value, but its intrinsic value, because I think we're entering an area that the insolvencies are going to put a lot of pressure on the market, and we could see another March event before the year's over.
Yeah, we've got a huge chunk of money that can no longer get decent yields, and they're having to chase these riskier sectors. But if gold prices stay high, these gold companies, and particularly like Australia's the great example, that the margins are just so high, they're going to be able to keep paying out healthy dividends. But I want you to walk people through the beginner's definition of a dividend versus the streaming versus royalties, for them to understand how these different companies can pay out.
So let's pretend I have a big gold company and they pay a dividend. So what a dividend is every single shareholder of the company gets an actual dividend, and the average dividend, believe it or not, is not that impressive in the gold sector. It's like 1%, if even that. So the gold guys are just starting to get to that area, because between 2008 to 2014, they put so much money that just went to money heaven on projects that didn't pan out, cost overruns, blah, blah, blah. Barrick, Goldcorp merged with got bought out by Newmont. Anyways, there's been now financial discipline, and the investors want a dividend, but they're not big dividends. Then you have the real royalty and streaming companies. So let's say the biggest in the world, like Franco-Nevada, where Pierre Lassonde started the company. What they do is they go to a gold mining company. And because these royalty companies trade at a premium to NAV, and most of these guys building a gold mining company are trading at a huge discount to NAV. So the average developer index in the gold market's 0.6 to NAV. So that's 60% of its NAV. But these streamers are trading at like 200% NAV. So their cost of capital is way lower than the gold company. So let's pretend you're building a copper porphyry with gold as a byproduct. And if it's a big gold porphyry, the gold streaming company will say, hey, we'll give you a big chunk of cash for the life of the product, and you can structure a royalty or a stream. So a stream would be, hey, we'll take 50% of the gold at $200 or $300 an ounce. I'm just making up a number. It could be 500. It's all how you play the math. And we pay you $500 an ounce, regardless of what the price of gold is, because we're giving you this money up front. But that goes for the whole project up front. That's how streamers work. Royalties are a bit different. And then all of these have been evolved, and it's a pretty crowded space, to be honest with you. You look at some of the deals that they're going, the streamers, because they're trading at such premiums, have to allocate capital, and they're going down the food chain to things that don't even have permits. It used to be Franco-Nevada and Silver Wheaton, which is now called Wheaton Precious, then the Assisto guys and Sandstorm, and then you had Royal Gold is another good one. They came in, and now there's like 25, 30 of these royalty and streaming companies, and there's so many. There's a fixed amount of assets that you're going, so they're going to down the food chain, riskier jurisdictions, and I just warn people to be super careful about it. So that's kind of did that explain it for you?
Yeah. I was real surprised to hear that number, because it must obviously be different in Australia, where we love dividends for all stocks. But the gold stocks, there's a few that are paying pretty healthy dividends, and some that have even got a bit funky, and they're paying out a dividend in actual physical gold. You can have that kept at a bullion dealer for you, which is pretty cool. Something a little bit different. Anything else to touch on, Marin, in that space? I guess it's a little bit. It is like a lot of those different sectors now, where people are going down that risk curve in every industry and every asset class, as you say, to try and get that bit extra.
I don't think you need to go down the food chain. I really don't, because I've been writing about this for years. Because of the money that's going to come in, they're legally not allowed to go down the food chain. So if you're going to do that, make sure you understand, if you're going down the food chain, really understand the risks associated, because you're taking massive risks. Now, I'm not saying pay 300% premium to NAV, because that's insane too. That's a high risk. But there are certain companies that are still trading at a discount to NAV and are run by incredible management teams that are producing 650, 700,000 ounces of gold, that are just starting to attract that passive capital. They're just starting to get into the index funds. And as that price goes up, you can de-risk here. So I just don't see. Now, look, if you invest early into something with a huge exploration success, yes, you're going to get a 10-bagger. But I just think that the odds of that are very low. And if you're starting out, I would start up the food chain, and as you get more comfortable, then go down the food chain.
Absolutely, yeah. I've got a bit of a theory that I'll run past you as well. And look, people talk about price suppression, and I'm not really sure where I fall on that, because gold is nearly 3,000 an ounce in Australia, and it's up there at 1,800 with everything that's been happening. So maybe prices are suppressed with these naked futures and short selling. I'm not sure, but either way, this theory I've got that every other sector is fully priced or overvalued, trading at these record levels, apart from the gold sector, really. So it's no longer in the Fed's interest or the government to just crush these industries, like we saw them sort of come in, and Trump says, I'm going to rescue oil and gas. Why would they try and suppress the price? They're better off letting these things run and creating lots of jobs and overinvestment and more miners and exploration. Does that sort of make sense, what I'm saying there?
Totally makes sense, actually, and I'm with you on it. I'll even share a deeper story on it. So a lot of the guys in the industry, like there's something called GATA, or they yes. believe that there's manipulation in sport. Look, it's a great theory, conspiracy theory, and this and that. And the guys at GATA feel that I don't like them. I like them. I like everybody. I like everyone who's entertaining, but make the difference between value and entertainment. In about a year ago, Raul and I from Real Vision, we had that whole little circle group. Kyle Bass, Brent was there, and I won't mention his name, but one of the head guys on the gold desk, actually, I think he is the head of the gold desk of the Goldman Sachs. And I asked that specific question. I go, if the GATA was here, what would you say to the price suppression? He goes, Marin, it's all about cost of capital. The guys who they think are manipulating it, here's the reality. They're playing with such big funds that they borrow at such a lower cost than anyone else. They're just looking after the returns. And if they see an ARB opportunity, they're just going to capture it. This guy said, I disagree with them that they don't understand the fundamentals, but that's not their game. Their game is just playing the market because of the cost of capital to get that capital, and they get a return on that borrowed gain. So when you think about it in that way, what certain people think is a conspiracy is just a market move that is irrelevant to them. Now, if they could do that in tech, which they probably are, it's all about cost of capital. You and I can't get capital at that rate, but the guys at Goldman Sachs can, and that's why they're doing what they're doing.
I'm just thinking, like in the comments, people are going to say there have been charges about manipulation, but I mean that happens in all markets. And I think what you're kind of explaining is that arbitrage, or if they can get this leverage, 100 times leverage in futures markets, and there's an opportunity to profit, they might switch. They might swap. Bull market, they're probably going to be pushing it up as well. So
totally.
Yeah,
they forget that's exactly the same guys that did it. So the same people that are arguing about suppression or manipulation on the downside, when it swings the other way, they're going to be welcoming in open arms, right? Then they're going to say that they're value investors. Look, man, like everyone's got an opinion in this game. Just look at people's track record and what their agenda is. And when I've talked about this at a conference, and I had so much hate. Oh, like you're going to believe a guy at Goldman Sachs, because people already have a belief, and you're never going to change an opinion of someone who already has a firm belief. That too many people are living in this echo chambers, and they don't, regardless of what you say. The key is to keep an open mind. Yeah. So that's my take.
A question we get a lot is about silver. And in Australia, there's a company, you probably know it, Silver Mines, and they're completely undeveloped as far as I know, but they've got like over 200 million ounces of silver and just kind of sitting there in the ground. So what are the things that like would worry you, or what point would they need to get to for you to invest? Someone that has a huge deposit, is it just a matter of silver price getting there, or you're still looking for obviously a good management team? But what's the difference when people say, oh, there's all this silver's going to go up, and that's a great investment? What are the things that you need to look at?
Okay, so silver, where it's different than gold, is the main production of silver is actually from byproducts. Like if you look at the largest that we could all invest in easily in North America or in Australia is Pan American. It was created by my good friend Ross Beatty, who's the chairman. Now, for my take, if you look at the moves that Pan American has made versus the risk you're taking, it has no debt on its balance sheet, pays a dividend, and it's world class. Okay, it's the second largest primary silver producer in the world. And it's funny, the largest silver producer in the world is actually a gold company because of the byproduct. Okay, yeah. Fresnilo, the Mexican company, is number one. So, but if you compare the risk you're taking versus liquidity versus any of these junior silver, what I call silver bugs, silver speculators or silver investors are like gold bugs on steroids or crack cocaine. Okay, they are just so fanatical about it. And I just say, if you look at the gains of any of these silver guys versus something like Pan American, why would I take that risk when I've had, in our newsletter, we had just as big gains with something like Pan American, again, because of the passive capital isn't going down the food chain. They're going into things like Pan American. I don't need to take the risk. So now that's my take. Now, if you want to go into down the food chain, then you got to look at economics. Okay. Is this just crappy silver where metallurgy doesn't work? It's too deep. The mining techniques, the costs, are they a bunch of geos that are going to plan on building a mine? Well, I know one geo in 20 years that has actually put a mine into production economically. Okay. Most of the time they're complete shit shows. Keep geos doing geo work. Engineers do engineer work. Focus on your factor. Now, I would never want a lung surgeon doing a heart surgery on me. Same thing in the mining. Then you look at permitting. How long to permitting? What are the capex, the true capex, not just some PEA or a PFS, preliminary feasibility study, but really a strong bankable feasibility study. And then you look at time frames. So all these different aspects you got to go in. Now, I have done large investments in earlier stage exploration, but I look at the geology and why is it undervalued, and then who the management team are. And it always starts with people. So that's where I would look at it.
And I think I've seen it time and time again. Even in the past 10 years, you've probably seen two cycles where silver, the largest companies have done, hundreds of % gains if you time them right. And people are going down the food chain chasing these wild gains.
Yeah, so I just say, and I've been telling my subscribers for a long time, like, you don't need to go down the food chain. Like, our portfolio is done incredibly well. And I'm not down the food chain. I don't need to.
Awesome. The final thing I had was just a bit of a different topic. Something that's popped up recently, I've noticed, is the whole sort of green and renewable energy investing. It's been kind of underperforming, and then the pressure gets back on the fundies it becomes about performance, not necessarily, they lose their ethics a little bit. I guess that's what I'm getting at. Have you noticed that as well? Or?
Like I was the largest geothermal plant in America I financed, okay, that was built in 40 years, called Blue Faulkner. So I know the area really, really well. There's been an incredible amount of money that's gone to the feel-good environmental movement. And ironically, uranium or nuclear energy doesn't meet the criteria right now. I suspect when they see the changes that will happen in the nuclear sector, that these fund managers who are significantly underperforming will tweak and bring the actual fundamental argument for nuclear energy, because there will be an argument for it. That will take a couple of years. And, you look at the innovations, like, look, there's no secret, I was one of the largest shareholders of Altura when it got bought out. As a big win for us and our subscribers. But subsequently, the company that bought it out almost doubled, because it's paying a 2% yield, which is attractive in this market. And you sit there and go, holy crap, a 2% yield is attracting that much attention. And I like the guys. I'm not putting them down. I'm a large shareholder in Brookfield Energy Power. It pays a 6% yield for us, and our subscribers got a huge 50% gain on that one. But it's about their cost of capital. And if you're going to get into the green energy sector, thinking that these funds, again, I cannot emphasize enough, if you think the streamers versus the gold companies about cost of capital, if you're going to invest in the sector, always think about, if a junior is starting this stuff up, what is their cost of capital to get? And they just can't compete with a Brookfield, which is one of the largest, or someone like an Intergex that has an arrangement with the Quebec pension fund that's giving the money at 3%. But a smaller startup has to go to the market for 8 to 10%. And the margins are so thin in the green sector that it is one of the sectors that the biggest saying, the bigger, the better. That's really true in the green sector. So the problem is so much money has gone into the sector, and they have to allocate it because they have mandates. Like, you can't sit 50% cash in that sector. I think what you're going to see in the next 2-3 years is they're going to evolve into the nuclear sector, because they need, like you nailed it on the head. There's only so long a fund manager can talk about, the moral aspect of investing, but their investors want to make money too.
Okay. Now that's good to know, because I know everyone's interested in uranium, and probably one we'll dive into and spend a whole episode on in future. So, Marin, that's been fantastic. You guys have been killing it the last few weeks with your free stuff as well as your paid newsletter. So, guys, we've got a discount for that down below, and for members, we've got a special discount on top of that as well in the group we'll share. If you're a beginner, there's free stuff on the website. We've done some free videos on the basics of gold and silver as well. So, Marin, any final thoughts for everyone?
I think put time into perspective. And the only thing that I think people need to really understand is the risk. We all know that the real economy, like the average Joe, the blue collar guy, is doing worse today than he was a year ago. No one's going to argue that. But the markets, the stock markets around the world, because of the financial stimulus, the 2020 election, I think, is going to, I'm apolitical. I think all politicians are full of shit. But I think the risks associated to this election can have an incredible ripple in the markets. And the one thing everyone listening to here is going, okay, how should I reduce my risk? You can always get back into these stocks later, and never have FOMO, the fear of missing out, because if you have that, you've already missed out. I just think that people need to start planning now in this market for potential ripple effects, or the butterfly effect of that election and the potential results, because the way I'm looking at it, regardless of who wins, the market's probably going to go lower in the near term because of the risks going on. So you combine that with COVID and how that's going, and if there's no vaccine and things are still looking pretty tough, it's a pretty bleak market. So make sure you have cash on the table, because you can't take advantage of a sell-off if you're fully invested.
And that could be where Trump goes all in before the election on infrastructure, and that could be good for commodities. And that's probably something we should spend a whole episode on next month. So, yeah.
And he's already hinted to it that they're going to do it, right? So, that whole disciplined approach. The one thing I think that may haunt the Democrats in this election is the leader of the Republicans is someone that has no respect for the balance sheet. He's going to do and say whatever it takes to stay in power.
A good place to finish. Well, Marin, certainly appreciate your time as always. I hope you guys have enjoyed that one, and we'll talk to you again next month. Cheers.
Stay well, Alex. Take care.